Welcome to the Deep Dive. We're here to cut through the clutter and give you the essential insights from complex information so you stay well-informed without the overwhelm.
That's right.
Today, we're tackling the Q2 2025 earnings call for BJ's Wholesale Club.
Yeah, BJ's. Always an interesting one in the retail space.
Our mission here is pretty straightforward. Get past the headline numbers, really understand what management is thinking, and pull out the key takeaways for you.
And, look at how the market reacted too.
Yeah.
That initial reaction often tells a story in itself, sometimes different from the company's narrative.
Good point. Okay, so let's get started. Maybe kick off with a quick snapshot, the main financials, operational highlights, just the basics before we dig deeper.
Sounds good. So headline numbers first. BJ's reported adjusted EPS of $1.14. That actually beat the consensus estimate by about 5 cents.
Okay, so a beat on earnings, that's positive.
Yeah, and it's up 4.6% compared to last year. But here's the other side. Revenue landed at $5.38 billion.
And how did that compare?
Well, it missed consensus by roughly $0.11 billion. Still grew, though 3.4% year-over-year growth. But, a miss is a miss on the top line.
Right, that classic mixed bag. Beat on the bottom line, miss on the top. Always makes you wonder about margins and demand sustainability. How did the comparable sales look, especially with gas prices being all over the place?
Exactly. That's the core tension. So comparable club sales, if you strip out fuel, they were up 2.3%.
Which sounds okay, but
the expectation was closer to 3.2%, so a bit short there. And then if you add gas back in, comps were actually down slightly, 0.3%, mostly because fuel prices fell compared to last year.
Yeah, fuel can really mask what's happening underneath, can't it? Makes the headline number tricky. Still, despite the revenue miss and that fuel noise, there must have been some bright spots.
Oh, definitely. Membership fee income MFI was a real standout. It jumped 9% year over year to $123.3 million.
Wow, 9% on MFI. That's strong, very sticky revenue.
Incredibly sticky. Pure profit driver for them. And digital sales, another big one, surged 34% year over year.
34%. Okay, so digital is clearly still firing on all cylinders.
Absolutely. And profitability looked decent too. Adjusted EBITDA rose 8% to about $304 million.
And margins. Given the EPS beat, they must have managed costs well.
Seems like it. The merchandise gross margin rate, excluding gas, actually ticked up by about 10 basis points year over year. That helped push gross profit over $1 billion to $1.01 billion.
Okay, so good MFI, strong digital, decent EBITDA, slight margin improvement on merchandise, quite a few positives financially. What about operationally? What were they actually doing well?
Well, operationally, they kept up some impressive streaks. It was their 14th straight quarter of traffic growth.
14 quarters of traffic growth? That's significant.
And 11 straight quarters of market share gains. So they're definitely pulling customers in and holding on to them, or even taking them from competitors.
That speaks of volumes in this environment. Inventory, always a key metric.
They managed it well. Inventory levels were down 2% overall year over year, and actually down 6% per club.
So leaner inventory.
Right. But crucially, they said in-stock levels improved by about 50 basis points. So leaner, but still having what people want, that's efficient.
Good balance. Anything else operationally? Share buybacks.
Yep, they bought back about 375,000 shares for roughly $41 million during the quarter, returning some cash to shareholders.
Okay, so solid operational execution overall, which makes the market reaction even more interesting, right? Despite the EPS beat and these operational strengths, the stock dropped. What was it, 7-8%?
Yeah, it was a notable drop in pre-market and early trading, hit an intraday low around $96.63.
So what spooked investors? Clearly, the revenue miss and the comp miss played a role.
Absolutely. That seemed to be the main driver. The market keyed in on that top-line softness. Management, they pointed fingers primarily at the weather.
The weather excuse. Common, but was it credible here?
Well, they specified unseasonably wet and cold conditions, particularly hitting their core markets in the Northeast and Mid-Atlantic pretty hard early in the quarter. And they said this directly impacted traffic and sales in discretionary categories. Things like recreation, lawn, and garden. Those saw double-digit declines.
Double digits. Wow. Okay, that's more than just a slight dip. That suggests consumers really pulled back on non-essentials when the weather was bad.
It does. It underlines how maybe sensitive spending is on those items right now. But importantly, management did say the business accelerated as the weather improved later in the quarter in June and July.
Okay, so maybe a temporary weather-driven hit with signs of recovery. Beyond weather, what was the broader take from management, from CEO Bob Eddy, on the consumer? Are people stressed?
Yeah, Eddy was quite direct. He said consumers across all income levels are feeling stressed by high prices and, interestingly, tariffs too, making them choosier with their dollars.
Choosier. How did that show up in the clubs?
More coupon usage, definitely, and a bigger focus on private label products, trading down within the store.
Makes sense. But did overall spending hold up?
Interestingly, yes. Despite that caution, total spending actually increased on a per-member basis, which is a really important point. People might be looking for value, but they're still spending more overall at BJ's.
So leaning into the value proposition and inflation. What did they say about that?
They pegged inflation at about 1 point during the quarter within their basket.
Okay, so a cautious consumer, but one that's still spending more per visit at BJ's, likely seeking value. Given that backdrop, how is BJ's navigating? What are the core strategies they're leaning on?
Right. This is where their longer-term plan comes in. They're really focusing on a few key pillars. First, membership growth. That's fundamental.
The MFI numbers certainly suggested that was going well.
Absolutely. They hit 8 million members. That's a huge milestone. Represents 55% growth since their IPO just 7 years ago.
That's impressive growth.
And it's not just total members. The penetration of their higher tiers hit an all-time high of 41%, up 50 basis points just from the previous quarter.
So more members, and more of them are paying for the premium tiers. That suggests strong perceived value.
Exactly. And they expect that MFI growth to actually accelerate through the rest of the year, helped by acquiring new members, keeping existing ones, and that fee increase they put through earlier.
Right. The fee increase provides a tailwind there. Okay, so membership is pillar one. What's next? Digital.
Digital acceleration, absolutely. We saw the 34% growth number. What's key is how they fulfill it. Over 90% of those digital sales are handled by the clubs themselves.
Through things like BOPS, buy online, pick up in club.
Exactly. BOP, Express Pay in the app, same-day delivery. It's deeply integrated with the physical stores. And they noted more than half their active members now use the app regularly. It's becoming part of the routine.
That integration is smart, makes it sticky. What about inside the store, the Fresh 2.0 initiative?
Yeah, the Fresh 2.0 transformation. They called it an overwhelming success, especially how it initially improved the produce business.
And they're expanding that.
Yes. They rolled it out to meat and seafood categories back in May. Said they're seeing early positive results there, too, trying to replicate this success.
Makes sense to focus on fresh. It drives traffic. But what about general merchandise? That seemed to be the weak spot this quarter, partly due to weather. How are they addressing that?
They have a plan there, too, the GM evolution strategy. Even though overall GM sales were down, they pointed out that apparel, which is the first category they revamped using a more data-driven approach, actually saw low single-digit growth.
So a proof of concept, maybe. That the transformation strategy can work even in tougher categories.
That seems to be the hope. They're applying that data-led approach to improve the offerings and relevance across other GM areas. It's a work in progress.
Okay, transforming inside the club. And they're also building new clubs, right? Expanding the footprint.
Aggressively, yes.
Yes.
New club expansion is key. They opened 5 in Q1, did their first relocation in Q2 Mechanicsburg, Pennsylvania.
And the plans for the rest of the year?
8 more clubs planned for the back half, including significantly entering the Dallas-Fort Worth market early next year. That's a big competitive market.
Wow. So they're aiming for, 25 to 30 new clubs over 2 years?
That's the plan. It shows real confidence in their model and growth prospects, committing that kind of capital.
Okay, so memberships, digital, fresh food, GM evolution, and new clubs. That's a lot of moving parts. How does all this tie into navigating the bigger picture, the macro headwinds, tariffs, consumer stress, and what did they guide for?
Right, so on navigating headwinds, management stress they're committed to hold prices as long as we can. That's core to their value appeal.
Especially when consumers are choosier.
Exactly. But they're also being pragmatic, strategically shifting sourcing, reducing orders for discretionary things hit hard by tariffs, like seasonal decor.
So protecting margins where they can, even if it means less upside.
Yeah, they called it a prudent stance in a constantly changing, risky environment. Acknowledged it might limit upside versus original expectations, but it's about stability. And they highlighted inventory again, saying it's in the best shape it's been in 5 years or so.
Disciplined. Okay, so cautious on some fronts, but what about guidance? Did they maintain their outlook?
They actually raised their full-year adjusted EPS guidance.
Raised it, even with the Q2 revenue miss and the cautious tone.
Yep. Raised it to $4.20, $4.35, up from $4.10, $4.30 previously. That's a strong signal of confidence in their cost control and back half execution.
Interesting. What about comps?
They reaffirmed the full-year comparable club sales guidance, excluding gas, at 2.0%, 3.5%.
So holding steady on comps despite the Q2 miss, and CapEx, still investing heavily.
Planned at about $800 billion for the full year. So yes, big investments continue. One other point on guidance. They did mention a willingness to make short-term investments to deliver member value, meaning they might accept some pressure on gross margins in the back half, potentially through promotions or holding prices, to reinforce that value message and drive loyalty long-term.
Got it. Strategic margin pressure for long-term gain. Okay, so pulling this all together for our listener, how should you contextualize these mixed results? What's the core takeaway?
Well, the split between the EPS beat and revenue miss really highlights their operational strength, especially cost management. That's good. But it also clearly signals those external pressures impacting the top line, particularly consumer caution in discretionary areas.
But their core value proposition seems more relevant than ever.
Exactly. In an environment where people are choosier, BJ's model focused on value, driven by membership growth, and enhanced by digital and fresh food, seems, well, pretty well positioned.
It feels like there's a disconnect, though. Management sounds confident, raising EPS guidance, pointing to membership strength, but the market reacted negatively initially. What's the divergence there?
I think that's the key question. The market seemed laser-focused on the near-term softness, the comp miss, maybe worried about consumer health overall.
While management is looking at.
Management seems focused on the underlying trends. Membership hitting records, market share gains continuing, inventories clean, digital roaring ahead. They likely see the weather impact as temporary noise. It's that short-term versus long-term perspective clash.
And this strategic shift they keep talking about, moving away from fuel dependence towards membership, digital essentials, that's a multi-year play that market might be discounting.
Potentially. They're building a more resilient platform, less vulnerable to economic shocks, aiming for sustained, profitable growth. The market sometimes struggles to price in those longer-term transformations when there's near-term uncertainty.
What are the analysts saying? Are they seeing the long-term story or focusing on the short-term bumps?
Kind of split, as you'd expect. D.A. Davidson, for instance, highlighted the positive share gains, aligning with management. But then you have J.P. Morgan flagging the deceleration in same-store sales, echoing the market's initial concerns.
So, a range of views out there. Okay, this brings us to that segment where we brainstorm. Not financial advice. Let's be crystal clear on that.
Absolutely not financial advice, just thinking provocatively.
An outrageous but plausible trade idea based on this situation. Given the stock drop post-earnings, despite the EPS raise and underlying strengths, maybe there's an overreaction.
That's the premise. The sell-off felt largely driven by external factors, weather, fuel, and maybe didn't fully appreciate the raised guidance or the membership momentum. Suggests a potential disconnect.
So if you believe there might be a disconnect, how could you potentially play that? What's the idea?
Okay, again, purely informational. Consider something like a long strangle on BJ's options, but with a twist.
The strangle usually involves buying a call and a put. What's the twist?
The twist is financing part of it. You could look at selling an out-of-the-money put, say maybe a September 90 strike put, and using that premium collected.
To help pay for?
To help pay for an out-of-the-money call, maybe an October 110 strike call. Or even go out to November to get more time value if the price is right.
Okay, break down the rationale there. Why sell the put and buy the call?
Well, the thinking is the market might eventually recognize the underlying strength. If weather normalizes, maybe discretionary spending picks up a bit, and those membership and digital tailwinds keep blowing, the stock could get re-rated upwards.
So the call option gives you that upside exposure if the stock rallies towards, say, $110 or beyond.
Exactly. But selling the put provides a bit of a cushion. If the stock chops around or stays above $90 through September expiration, you keep the premium from selling that put, which offsets the cost of the call.
So it's a bet on a rebound, potentially financed partly by betting the recent low holds. A slightly contrarian take on the market's initial reaction.
Precisely. Betting that maybe Q3 and Q4 paint a clearer, more positive picture, and the market catches up to management's confidence. Again, lots of ifs and maybes there.
Definitely requires careful consideration and understanding of options risks. Okay, let's recap this deep dive on BJ's Q2. A mixed quarter, no doubt. EPS beat, revenue miss.
But underscored, really, by strong fundamentals in membership and digital. Plus disciplined operations. They're navigating headwinds, making strategic tweaks, but sticking to their long-term transformation plan.
Which leaves us with a provocative thought for you, the listener. It's fascinating how a company can beat earnings expectations, show solid operational control, yet still see its stock take a hit.
It really makes you ponder. Is the market overlooking the long-term potential, the strategic shift that's underway at BJ's? Or are these near-term headwinds, the consumer caution, genuinely significant enough right now to overshadow those strengths for a value retailer?
Something to think about as you do your own research. And remember, everything discussed here is purely for informational purposes. It is not financial advice. Always conduct your own thorough due diligence.
Absolutely.
We appreciate you tuning in. Send us your thoughts, your questions. We'd love to hear them for future deep dives.